50 years ago, investing was a distinctly human affair. People would have to take each other out, and dealers would entertain fund managers, and no one would know what the prices were, says Ray Dalio, who worked on the trading floor of the New York Stock Exchange, NYSE, in the early 1970s before founding Bridgewater Associates, now the world's largest hedge fund. Technology was basic. Kenneth Jacobs, the boss of Lazard, an investment bank, remembers using a pocket calculator to analyze figures gleaned from company reports. His older colleagues used slide rules. Even by the 1980s, reading the Wall Street Journal on your way into work, a television on the trading floor, and a ticker tape offered a significant information advantage, recalls one investor. Since then, the role humans play in trading has diminished rapidly. In their place have come computers, algorithms, and passive managers, institutions which offer an index fund that holds a basket of shares to match the return of the stock market, or sectors of it, rather than trying to beat it. See Chart 1. On September 13, a widely watched barometer published by Morningstar, a research firm, reported that last month, for the first time, the pot of passive equity assets it measures, at $4.3 trillion, exceeded that run by humans. The rise of financial robotization is not only changing the speed and makeup of the stock market. It also raises questions about the function of markets, the impact of markets on the wider economy, how companies are governed, and financial stability. America is automating. Investors have always used different kinds of technology to glean market-moving information before their competitors. Early investors in the Dutch East India Company sought out newsletters about the fortunes of ships around the Cape of Good Hope before they arrived in the Netherlands. The Rothschilds supposedly owe much of their fortune to a carrier pigeon that brought news of the French defeat at the Battle of Waterloo faster than ships. During the era of red braces and slide rules, today's technological advances started to creep in. Machines took the easier and loudest jobs first. In the 1970s, floor traders bellowing to each other in an exchange started to be replaced by electronic execution, which made it easier for everyone to gather data on prices and volume. That, in turn, improved execution by creating greater certainty about price. In portfolio management, algorithms have also been around for decades. In 1975, Jack Bogle founded Vanguard, which created the first index fund, thus automating the simplest possible portfolio allocation. In the 1980s and 1990s, fancier automated products emerged, such as quantitative hedge funds, known as quant funds, and exchange-traded funds, ETFs, respectively. Some ETFs track indices, but others obey more sophisticated investment rules by automating decisions long championed by humans, such as buying so-called value stocks, which look cheap compared with the company's assets. Since their inception, many of the quant funds have designed algorithms that can scour market data, hunting for stocks with other appealing, human-chosen traits, known in the jargon as factors. The idea of factors came from two economists, Eugene Fama and Kenneth French, and was put into practice by Cliff Asness, a student of Mr. Fama, who in 1998 founded AQR Capital Management, an investment firm that runs one of the world's largest hedge funds. Quant funds like AQR program algorithms to choose stocks based on factors that were arrived at by economic theory and borne out by data analysis, such as momentum, recent price rises, or yield, paying high dividends. Initially, only a few money managers had the technology to crunch the numbers. Now everybody does. Increasingly, the strategies of rules-based machine-run investors, those using algorithms to execute portfolio decisions, are changing. Some quant funds, like Bridgewater, use algorithms to perform data analysis, but call on humans to select trades. However, many quant funds, such as Two Sigma and Renaissance Technologies, are pushing automation even further, by using machine learning and artificial intelligence (AI) to enable the machines to pick which stocks to buy and sell. This raises the prospect of the computers taking over human investors' final task, analyzing information in order to design investment strategies. If so, that could lead to a better understanding of how markets work, and what companies are worth. The execution of orders on the stock market is now dominated by algorithmic traders. Fewer trades are conducted on the rowdy floor of the NYSE, and more on quietly purring computer servers in New Jersey. According to Deutsche Bank, 90% of equity futures trades and 80% of cash equity trades are executed by algorithms without any human input. Equity derivative markets are also dominated by electronic execution, according to Larry Tabb of the Tabb Group, a research firm. This must be the place. Each day around 7 BN shares worth $320 billion change hands on America's stock market. Much of that volume is high-frequency trading, in which stocks are flipped at speed in order to capture fleeting gains. High-frequency traders, acting as middlemen, are involved in half of the daily trading volumes. Even excluding traders though, and looking just at investors, rules-based investors now make the majority of trades. 3 years ago, quant funds became the largest source of institutional trading volume in the American stock market, see Chart 2. They account for 36% of institutional volume so far this year, up from just 18% in 2010, according to the Tabb Group. Just 10% of institutional trading is done by traditional equity fund managers, says Dubravko Lakos-Bujas of JP Morgan Chase. Machines are increasingly buying to hold too. The total value of American public equities is $31 TN as measured by the Russell 3000 and index. The three types of computer-managed funds, index funds, ETFs and quant funds, run around 35% of this, see Chart 3. Human managers, such as traditional hedge funds and other mutual funds, manage just 24%. The rest, some 40%, is harder to measure and consists of other kinds of owners, such as companies which hold lots of their own shares. Of the $18 trillion to $19 trillion of managed assets accounted for, most are looked after by machines. Index funds manage half of that pot, around $9 trillion. Bernstein, a research firm, says other quantitative equity managers look after another 10 to 15%, roughly $2 trillion. The remaining 35 to 40%, worth $7 to $8 trillion, is overseen by humans. A prism by which to see the progress of algorithmic investing is hedge funds. 4 of the world's 5 largest, Bridgewater, AQR, Two Sigma, and Renaissance, were founded specifically to use quantitative methods. The sole exception, Man Group, a British hedge fund, bought Numeric, a quantitative equity manager based in Boston, in 2014. More than half of Man Group's assets under management are now run quantitatively. A decade ago, a quarter of total hedge fund assets under management were in quant funds. Now it is 30%, according to HFR, a research group. This figure probably understates the shift given that traditional funds, like Point72, have adopted a partly quantitative approach. The result is that the stock market is now extremely efficient. The new robo-markets bring much lower costs. Passive funds charge 0.03 to 0.09% of assets under management each year. Active managers often charge 20 times as much. Hedge funds, which use leverage and derivatives to try to boost returns further, take 20% of returns on top as a performance fee. The lower cost of executing a trade means that new information about a company is instantly reflected in its price. According to Mr. Dalio, order execution is phenomenally better. Commissions for trading shares at exchanges are tiny, $0.0001 per share for both buyer and seller, according to academics at Chicago University. Rock bottom fees are being passed on too. On October 1, Charles Schwab, a leading consumer brokerage site, and TD Ameritrade, a rival, both announced that they will cut trading fees to zero. Cheaper fees have added to liquidity, which determines how much a trader can buy or sell before he moves the price of a share. More liquidity means a lower spread between the price a trader can buy a share and the price he can sell one.